Hello, Ghost Traders. This is your market update. Today is July 13th, 2024. It is a super hot Saturday, and this is your instructor, Scott C. Let's start by talking about this crazy market. So I've got the chart of the S&P 500 up, and you can see that we are just uptrending, higher highs and higher lows. So let's focus in on what happened this last week. So as we look at what the market did last week, we're going to start with this big day here on Wednesday. Wednesday was the day that Jerome Powell testified before Congress. So if we go back here to the Forex Factor, you can see on Wednesday, July 10th, Fed Chair Powell testifies. Let's go over here to the right, click on this detail. It's a little folder that lets us see deeper what happened. Now I'm going to go down to these news articles over here, and we can take a look at each one of them, but I am going to focus on this one from Bloomberg right here. So I'm going to click on this headline. And then up here near the top, let's click on full story. Now I think you can see, as this headline implies, that Jerome Powell said that he's not confident about inflation. He knows that the market really hinges on everything he says, so he does this double speak and he's very cautious about what he does say. But some of the key takeaways is that inflation hasn't gotten down to the central bank's 2% goal. Now, the numbers have been looking pretty good. Inflation has been coming down. But he said right here where I'm highlighting that recent price readings have shown modest further progress. And we need some more good data to help with their confidence that inflation is getting down to its 2% target. Now, he avoided giving any strong signals on the timing of interest rate cuts, but if you go into the CME Fed Watch tool, interest rate traders are trading as if at the next FOMC meeting, which is July 31st, it's going to be in 17 days. You got the countdown clock up here at the top. Those interest rate traders are trading as if there's a 93, almost a 94% probability that interest rates are going to stay the same. However, if you've been paying attention to this tool, if you go out to September 18th and you've been watching these graphs right here, interest rate traders have actually been increasingly predicting that interest rates will be cut at that meeting. Now, it's not from what Mr. Powell said on Friday, but it's all about the numbers that came out on Thursday. We had the CPI, the core CPI, and we had the unemployment claims. So I'm going to go out here to the right. I'm going to click on this little folder. Let's open that up. And if you look at June here, the forecast was 0.3% and the actual number was 0.2%. So since inflation has dropped here in June, this kind of clears a path for the Fed to cut interest rates at least by the end of the summer. If you follow my cursor right down here, why traders care, basically the consumer price index is a measure of goods and services and costs across the economy. Core prices, which exclude volatile food and energy items, are seen as a better gauge of underlying inflation. Now, core prices have actually rose 0.1% since May, but that's been the mildest increase since January of 2021. So basically, since we're seeing some slowing, that's a confidence booster for the Fed, and it leaves the door wide open for these September interest rate cuts, and the market is very sensitive to interest rates right now. Now, going back to this CME FedWatch tool, investors still aren't expecting a rate cut to happen at the end of July, but you never know. Maybe something will happen that'll take the market by surprise. Now, one thing I want to touch on is that this report that we had on Thursday is pretty comforting to policymakers because it showed that housing costs are slowing after a huge run-up following the pandemic. Now, housing inflation, which reflects the cost of renting and accounts for about 1/3 of the CPI, has kept overall prices high. Something that's kind of interesting is that rents have actually been cooling for the last year and a half, and economists have seen this, and so they know that this figure often trails market conditions by quite a few months. So I think they saw the writing on the wall that some of these inflation numbers were likely to come down. We've seen U.S. airlines cutting ticket prices, but you've also seen insurance companies kind of keep their insurance prices a little bit higher because you've had a huge increase in car prices. So there's a lot of moving parts going on in here. One other thing that I want to touch on, let's go back to the GhosTrades website, and here's our Wednesday market activity after Mr. Powell spoke. So on Thursday, we were looking for that inflation data to show that the economy was cooling off, but we didn't want it to cool off too much. We don't want to look like we're going into a recession, but we don't want everything to be way too hot and make it look like inflation is just not slowing down. So we actually fell right within the range that I think the market was happy, but you got a little bit of a sell-off because we've already had such a huge run-up in price. And then Friday, we got a little bit of a bounce. It looked like we're going to try to break to new highs, but we cooled off by the end of the day. I'm going to pull up a chart of IWM, and this is the Russell 2000. This is an index with 2,000 smaller cap companies, mid to small cap companies. Now, as a quick refresher, market capitalization is just how many shares there are outstanding times the price of the stock. So if you had two companies side by side, company A and company B, and company A's stock is $1 a share, company B's stock is, let's just say, $50 a share. Well, normally people see that and they immediately assume that company B is a bigger company. Well, let's just say company A has 10 million shares outstanding. So 10 million shares outstanding at $1 a share, the company is really a $10 million company. Company B, their stock price is 50, but they only have 10 shares out there. 10 shares at $50 a share means it's a $500 company. It's tiny. It's probably something that somebody's running out of their basement. That's probably not a good example. Maybe they have 1,000 shares out there. 1,000 shares at $50 a share, that's a $50,000 company, much smaller than company A. So even though company A's stock is only $1, it's a much bigger company than company B. So that's how we measure the size of the companies. And if you can look at this graphic right here, mega caps are the really big ones. Apple, Nvidia, over 300 billion market cap. You got your large caps, mid caps. Now small caps is anything between 300 million to 2 billion in market capitalization. So the Russell 2000 is basically an index of 2,000 small cap companies. And the reason I'm bringing this up is because even though we saw some pullback on the S&P 500, look what happened right here on the Russell 2000. I'm going to zoom in, and here is Thursday. That looks like a legitimate breakout. This big breakout is showing some enthusiasm about the inflation report. So a move by the Fed to start cutting interest rates could be especially helpful to smaller businesses because they tend to have more floating rate debt than larger companies. So basically, last week in the market, I think the biggest takeaway is that there's signs that the economy has cooled down just a little bit, but not enough to stir fears of a recession. But just enough to spur a change of tone from the Fed. So instead of keeping rates the same, I think everybody's starting to expect some rate cuts right around the corner. I've got a chart of JP Morgan up here now because they had earnings on Friday, and it looks like it was down just a little bit. It was actually a big day for major U.S. banks. JP Morgan, Wells Fargo, Citigroup, they all went down despite having solid quarterly results. And I think what the market was seeing is that even though their earnings revealed record revenues, they were the result of one-time windfalls. Their forward guidance really had investors a little bit nervous. One thing that I like to keep an eye on when it comes to financial stocks is FAZ. This is a triple leveraged bearish ETF. So if banks really start to struggle going forward, this ETF can have a nice upward movement. But keep in mind that these leveraged ETFs have contango. They have costs associated with them because these guys are using futures contracts to create this exchange traded fund, and the costs of rolling those future contracts kind of get put into the stock price. So it gives it a little bit of a bearish and kind of a negative bias to the price. But hey, if banking stocks start to struggle, you could see something like FAZ really take a nice move up. So at least one to keep an eye on. So what's next? What should we expect out of the market over the coming week? Mr. Powell is going to speak again on Monday, and depending on what he says, whether he's a little bit more dovish, which is peaceful talk, peaceful monetary policy, which involves interest rate cuts, the market could really like that and go up big. But if he's a little bit more hawkish, then the market's not going to like that so much. So let's see what happens here on Monday. Tuesday, you have some more inflation data, but I think the big one happened last Thursday. Nothing major on Wednesday. You've got some more inflation data with the unemployment claims on Thursday. And then again, nothing really big on Friday. So mostly what it comes down to is the market has been making higher highs and higher lows. We're overextended. We're overdue for a pullback. We've had some good news, yet that could be priced in, and we could potentially see some profit taking. Take a close look at where my cursor is right here on the price of the SPX, and then go down and look at this MACD indicator. Notice how the prior high on the MACD right here was a little bit higher than where it is right here. MACD making lower highs, yet if you go up there and look at the corresponding highs on the market itself is making higher highs. That's what we call a bearish divergence. So this indicator is giving off some signs of weakness. Now, in all fairness, we had another bearish divergence right here. Market made a high, MACD made a high. Next high on the MACD is a little bit lower, yet the market went on to make a higher high. That was a bearish divergence also, and that didn't really play out. Didn't really do what it was supposed to do. I think a lot of strong numbers, a lot of money moving into the market has kept the market propped up. But again, don't be surprised to get a little bit of a pullback. We are in an election year, and generally in an election year, those elected officials try to do whatever they can to keep the market strong, to help their chances of being reelected. I think this is really kind of an odd year because who's going to end up on the ballot? I don't know that there's really a clear answer to that. So there should be some maybe some volatility, some indecision in the market itself. Now, finally, before I sign off, I just want to touch on Bitcoin. Again, I'm still bullish. We had the halving. Bitcoin in the past has tended to do really well after the halving. We're getting a little bit of a pullback, and you can see that with this double leveraged Bitcoin ETF, BITX. I think this is one of the holdings we have in the shadow account. Since it is a long-term holding, I'm not too worried about it. Yeah, I can hang out under 30. Great. Good time to buy into it a little bit. Don't be surprised. Sometimes trends can last for a while, and if you look closely at the 50-day moving average, it's starting to come back down. We've broken below the 200-day moving average. That's not a good sign. But Bitcoin has done so well for so long, there's bound to be some consolidation. It's a very volatile asset. So if you're trading stocks that follow the price of Bitcoin, yeah, they're going to be pretty volatile as well. I'm still bullish. I think as a long-term buy and hold, something like this could have great potential, but still manage your risk accordingly. Okay, everybody. So that's our market update for this week. Whatever you decide to do with your money out there in the market, good luck. Manage that risk appropriately, and always continue learning.